All right, we are going to have some fun today as we have another 7702 product update, company update. Let's get into it. So in our last 7702 update, we looked at a comparison of MassMutual's 10-pay product. As they've made that available, right now you can purchase their old product that still has the 4% guarantee and is based on the old Mech Limits, or their new 10-pay product, which has a 2% guarantee and complies with the new Mech Limits. And then MassMutual will be updating all of their products November of this year, toward the end of November. So today we're going to go through Guardian. So they released 3 of their core products. They released their L95 product, L99, and ESWL, which stands for Executive Strategies Whole Life Product. Now, their Executive Strategies product is not available to everyone. That product is primarily designed for high net worth individuals and corporate benefit planning. So what I mean when I say that is when you look at the base premium requirement for a single policy on one individual, it's $100,000. If it's a policy on a corporation where there's a number of lives, the minimum base premium requirement is $50,000. And that's not including PUAs. So that has a high base premium requirement. Their L95 and L99 products are more of their core products, which are available to everyone. So we're going to look at both of them in this video and really just take our time going through everything. If you are in the business, this will provide a lot of additional information that should help you, and you'll see a lot of similarities with a number of companies. If you are a consumer, meaning you're in the market for a policy, you do have a unique opportunity right now that really has not existed since the 1980s, and it exists for the next 4 months. And what I mean when I say that is the old product with the 4% guarantee and also the current Mech Limits, those are available between now and the end of 2021. Once the new year hits 2022, the 4% guarantee will be off the shelf and only products based on the new Mech Limits and then the new guaranteed rates will be available. And why I say new guaranteed rates is all companies have the option to set different guaranteed rates. So as we get into this, I'll start with Guardian here. Guardian filed all of their products to have a guaranteed rate of 3%, where it was 4%. So that is a 1% drop. And most of the major mutual companies did that. New York Life and Northwestern Mutual did the same thing, filed at a 3% guarantee. I got to double check with Northwestern Mutual actually, but I believe those 3 carriers all filed at a 3% guarantee. MassMutual did things a little bit differently. We touched on their 10-pay product in a past video that has a 2% guarantee. I'll mention that their Legacy 100, when that comes out in November, that'll have a guaranteed rate of 3.75%. And then all of the other products will fall in the middle between 2 and 3.75. So they mixed it up a bit, which is always interesting. And then Guardian and the other carriers just went with a flat 3%. But as I often mention in all of our content, anytime you look at a guaranteed rate, a total dividend rate, whatever it might be, is always factor in that that is a gross rate that is credited after the company's insurance expenses, mortality charges, everything. So really what I want to look at every single time, if I'm interested in a cash value life insurance policy and cash value is the driver, is the internal rate of return. That'll go such a long way in determining my net cash value growth, just as the years pass. So we're going to examine the L95 and L99, beginning with the old product. We had a guaranteed rate of 4% for 2021. Guardian declared a surplus of 1.65%, giving you the total dividend interest rate of 5.65%. The new L95 product has a guaranteed rate of 3%. The same total dividend interest rate of 5.65 applies. So what that means is that we will have a surplus of 2.65% on top of the 3. The 2 together give you that 5.65%. Now, we're going to get into that as we look at a life insurance illustration, really what that impact means. And just to kind of sum this up, because I know this is a lengthy recording, is the trade-offs. The old product, you will notice the guaranteed values are stronger, the net guaranteed value. So that makes sense because the old product had a 4% guarantee. And the upfront cash values were much stronger. You're going to have to pardon my poor penmanship on the screen. Whereas the new product, when you look at the non-guaranteed values, especially long-term, they are stronger because they're more sensitive to the dividend rate. And again, we're going to go through that in detail and really what to look for if you're in the business or if you're not in the business and you want to know the details, or if you just want to see the net cash values, we'll show you exactly what those are too. So let's get on into it. A little bit of additional information on Guardian first. They will be releasing the rest of their products for the most part the end of this year in the fourth quarter, and that will be their 10 pay, 20 pay, and L65. Their L15 is actually going to be phased out for the moment. And then they will also release the L121 and survivorship whole life product during either the first or second quarter of 2022. So all of those products are available right now based on the 4% guarantee and old Mech laws, but these are specifically the ones I just highlighted there have to do with the new Mech laws and the 3% guarantee complying with the new 7702 change. So what we're going to look at in the case study, we're going to begin with the L95, comparing the old product to the new product. We're going to look at $100,000 per year paid in for 5 years. And what I'll mention here is short funding periods will maximize the internal rate of return of a product. And that's the case based on guaranteed values and non-guaranteed values. If you have a case where you are funding up to that Mech limit really for 7 years or less, you can do a lot of damage when you look at the internal rate of return. You can damage, when I say damage, in a good way, really boost the values. So what we're going to look at with both the old and new is a 1090 split. 100K per year total going in. And then also on the Mech limit, $100,000. So the goal here is really a laser focus on the cash value to see what is the difference if I'm in a situation where I say, here's how much I want the ability to pay into a policy per year. The death benefit is not that important right now. I like the cash value. What is the difference between the old product and the new product? This way I can see it and make an informed decision. So we've got a 1090 split, which means a $10,000 base premium and term rider. So the actual base is less than 10K in this example. We've got a blended PUA and term rider, as that's the only way we can consistently 10x our base premium PUAs with Guardian. And that is really done to raise the Mech limit and build in that flexibility. And then 90,000 allocated toward PUAs. Quick side note to Guardian. So they've got a ton of flexibility. What you can do with this design is really commit to the minimum base premium only. And then at discretion, you can just pour funds into PUAs whenever you want through your online portal, mobile app, very flexible in that respect. Now, the assumptions we're going to look at is as follows. Guaranteed values, 4% in the old, 3% on the new one. Dividend values, gross rate, 5.65% on both, because the dividend rate's not going to change. And then the indexed feature assumption as well, which we've got content on that if you'd like to learn more about it. Now, the Mech limits. Here's a big difference. The old product with a 4% guaranteed rate. For age 40 male, so that's what we're going to look at first, $2.8 million in total life insurance will obtain him $100,000 in a Mech limit, a little bit north. I just rounded off in the death benefit. The new product, which is a 3% guarantee, so that is a trade-off there. Only $2,050,000 in total life insurance for the same 40-year-old male is needed to obtain that $100,000 Mech limit. So we've got the minimum death benefit needed in order to obtain that 100K Mech limit. In both examples, we will have the minimum base premium. But if we have a lower death benefit, the overall life insurance cost will be a little bit lower. But here's the main thing that will be lower: term rider cost. And it's not a huge difference. I'll actually point that number out so you know exactly what it is in the first year. And in future videos, we will have studies where we look at all years of it, as we have in the past with 1 year and level term riders. So what we're going to look at, funding period L95, which is that hybrid product I'll often talk about, where they only overcharge us for the base premium in the first year. We're going to look at that. Juicing the policy for 5 years, guaranteed, dividend values, indexed feature, old and new comparison. Then we'll also look at the L99 product. And what we're going to look at is a lifetime fund. So we're going to max fund it for 7 years at 100K per year, and then just $25,000 per year thereafter. And we're going to look at the same assumption there: guaranteed, dividend, and indexed features. The main reason why is a lot of people do like to look at that. When I say like to look at that, a lifetime fund where they state, hey, I do want to max fund it. Maybe I'll stop after 7 years, but if I want to keep pumping money into it, can I? The answer is yes. And then what would that look like? And if I do want a product where I pay in for a long period of time, the L99 produces slightly more value, not a whole lot. And it's something, if you've worked with us, you know this, we like to show a number of options. But for this example, just to maximize the long-term IRR, that's why I used that. We're also going to look at the end of this, very briefly, a split study here, where we still look at a minimum 10/90 split and then a 25/75 split, really to test the dividend treatment on base premium dollars and really see what the difference is with that 7702 change. I'll let you know, it does favor that 10/90 split even more when you look at it. And then with the L95, just a quick side note here, after the 5-year funding, we're going to look at a reduced paid up in policy year 8, earliest we can do it. So after that 7-pay test, chop the death benefit off, chop the base premium off and the old product and the new product. So we have an apples to apples comparison. And what that means, that reduced paid up option is a L95 is payable until we are 95 years old. However, if we go reduced paid up in year 8, what that means is whatever the premium is, we're chopping it off, it's gone. So even if I want to pay anything into the policy, I cannot. I can borrow and repay all day long, but I cannot add anything in. And again, by going reduced paid up, the internal rates of return will be maximized short-term and long-term in that particular example. And then we'll look at a long fund with the L99 as well. So let's get into it. Then we're going to look at the loan rate adjustment. That'll be really interesting when we see the changes there, because Guardian is a direct recognition company initially, even though they offer non-direct recognition. So let's begin with the old and new. Let's start off with the old one, what we're familiar with. So age 40 male, preferred plus, 100K per year going into the policy for 10 years. I'm sorry, for 5 years. If I'm you and I'm buying a policy with any life insurance company and I'm presented this life insurance illustration, my question would be this, with the knowledge I have just being in the industry, is where is my money going? And is it maximized for cash value if that is my goal? And here we go. Money can go where? Toward the base premium or toward the PUA rider. Here's the premium, $9,090, almost $9,091. Where we came up with that number specifically, and we've touched on this in other content, are all about Guardian video, really touches on this. Wherever we set that base premium, Guardian will allow us to pay 10x the base premium in PUAs per year. So technically, that's a total of 11x. It comes out to about 10x though, because we have to account for the term rider. So old product here, that base premium, about $9,100, purchases us a whole life death benefit of about $520,000. If I stop there, that gives me a Mech limit of right around 20K or so, a little bit less. How we got that up to $100,000 Mech limit, because what has a direct relationship to the Mech limit? My age and total death benefit on a life insurance policy. This is the old product again. $2.8 million death benefit. Okay. So what we did to get to the 2.8 is this guy. We added a term insurance rider. Here we go. You can tell I love this stuff, right? There's the cost of the term insurance rider, again with the old product, about $760 for the first year. And then as we pump money into the policy, whole life death benefit goes up, term rider comes down, keeping me level at the 2.8 until we chop that term off. But here's what I want to touch on. So again, we're looking at the old one, old product here, old product here. You'll see why I'm so emphasizing that point so much. Look at your first year cash value, almost 89%, 88,747. This is an ultra preferred 40-year-old male. When's your break-even point? This is based off the present dividend rate right here too. Breaking even between years 3 and 4 under the net cash value column. Paying nothing after year 5, cash value continues to grow. Okay, keep that in mind. Let's go to the new product. Identical out of pocket. Identical Mech limit. What's the first difference, or what's a similarity, I should say, that you notice first? 100,000 out of pocket. And if you said, I don't care about the death benefit, I'm interested in the cash value, show me the maximum value, maxing out the insurance company's limits that they make available. What do you notice here? Check that out. Premium is identical. I'm off by literally 1 penny compared to the old one, but premium's identical. There's the PUA. Now, what did that premium get you in whole life death benefit in the last one? 500,000 and change. Now you're at 462. Total death benefit. What was in the old one? 2.8 million. What is it here? 2,050,000. So here's the thing, that 2,050,000 gives you a Mech limit of $100,000. So what we are doing is minimizing the insurance expenses based on how much someone wants to be able to pay into a policy per year. If they said, hey, I want to be able to pay in 200 grand per year, that death benefit would be about 4.1 million. It's all relative in that respect. And we've got videos that really go through the Mech limits and exactly how to set that limit wherever we want. We are going to be redoing it based off these new limits. That way the content's accurate, just if you're ever comparing and contrasting and trying to figure out if you want to move forward with a policy or not. But lesser death benefit, which means we need a smaller term insurance rider. And if the term rider's less, what else is less? There's the cost. Interesting, isn't it? A couple $100 less, not a huge difference. Now, on the last example, I emphasized the first year cash value. And what did I mention there? Almost 88% is what I said. Or did I say 89? Let's go back. Almost 89%. Look at that. That's the old product, 88,747. Look at the new one. So all things are equal here in terms of your design. There's your base premium, 100K out of pocket, less going toward the term insurance rider. But look at this, the same L95 product. Cash value, almost 84%, 5% less. Like, what's going on here? Here's exactly what's going on. So under the key observations piece, we're going to touch on this briefly later. I'll dig into it right now. Is Guardian's PUA load has always been at an industry low, 5%. Most companies will charge between 7.5% to 10% for PUA riders. Some will charge more than that. Guardian's has always been low, and that had really enhanced the upfront cash value. They've raised it to 10%, really to be more on the same page as their peers, competitors. But I look at that, or I try to look at it and say, hey, if I'm a consumer, if I'm not in the business and don't understand the mechanics of the insurance product, I would think, well, that was a competitive edge. Why did you get rid of that? Was it to try and recoup more costs so you remain profitable all the time? Partially, but the main reason why, and this again has to do with the non-guarantees based on the dividend assumptions, is when you raise that PUA fee and we look at the long-term performance, that will be enhanced. So an example to that is if you look at illustrations, so not actual performance, which you know how big I am on that, but illustrations. If you look at a company like Mass Mutual, Penn Mutual does this as well. They have higher PUA fees. Penn Mutual has a very high PUA fee. And that is one reason they're able to project such strong long-term performance. The company's taking more upfront. They can do more with that money. There's a lot more that goes into it, but often you will see the higher the PUA fee, the greater the long-term performance. That's something Guardian has provided some information on as well. And if you're an agent, feel free to reach out to us with questions if you are part of our academy and you work with us. But let's continue on here. So main thing is why we see that cash value less with a new product is a direct result of the fee, the PUA fee now being 10%, not 5%. And if that doesn't fly for you, the old product's available through 2021. Once 2022 hits, the old product will not be available. And keep in mind, they're releasing additional products as well, some limited pay products, which often credit more cash value up front. So there could be ways to alleviate that too. But anyway, that's a drawback. What's another drawback? Old product broke even between years 3 and 4. This one's pretty much year 5. And this is their L95 product, which is designed for high early cash values. So we're aiming for an early break-even point, a little bit delayed there. That's the drawback right there, in my opinion, that and the guarantees. So we're not going to flip back and forth between these two screens. That would be not fun. Let's simplify this a bit. So what we're going to look at first is the worst part. The worst is first. So when I say the worst, we're going to look at the pure guaranteed values. No dividends assumed at all, ever. Old product had a guarantee of what? 4%. New product, guaranteed rate of 3%. As we look at the guaranteed values, what do you notice here? About 89% right off the bat with the old product, about 84% right off the bat with the new product. Look at the annual IRR difference. When's the worst part about a whole life insurance policy? Always in the first year. So let me touch on something here, actually. This will add some more context. When I look at the L95 and L99 policies, Guardian's L95 product, when I look at premium dollars, specifically premium dollars, not PUA dollars, in respect to cash value, nothing shows up in the first year. Beginning the second year, those premium dollars come back. With the L99, nothing shows up in the first and second year. So the company is going to overcharge a consumer for the base premium in the first and second year of the product. Once we pass the first year, or L99 first and second year, premium dollars start to come back to cash value. But here's what I want to touch on. So first year, premium's not showing up. That's taking the biggest bite out of performance. But what's the difference here? It's almost a clean 5%. Here's the reason why. Going back to that PUA fee, it's very interesting here. The old product, it was 5%. The new product is 10%. That's what's going on there. That's why I see just about 5% less. And we'll have PUA videos available for everyone we work with. If you work with us, you've probably already seen that PUA analysis video with different companies. So what do we notice here in the guarantees? Old product, breaking even between years 5 and 6. That's strong. Guardian's always been known for their lower insurance expenses, and you can juice those early cash values if you do things right. The new product, the guaranteed rate came down a full percentage point. As a result, when I look at this, the break even falls between years 8 and 9. I have paid in a total over $500,000, and that's when I have $500,000. Now that is still pretty good. If you recall the first 7702 update video we did with the Mass Mutual 10-pay product, that broke even between years 11 and 12 based on the new product. Now that had a 2% guarantee, so that's really not a fair comparison. With more to come as they release their other products, but still, I do see a difference there. And I'm expecting to see a similar trend. Like companies, they did a good job, both Mass Mutual and Guardian. I got to give them a ton of credit from a business perspective, where they attempted, and they did it, to ease into it. So when they present this to their consumers, their sales force, to present to potential policyholders, they tried to make minimal changes, keep just the overall structure and foundation of the product exactly the same, and make the changes that are necessary, and some enhancements here and there. But anyway, let me continue on, because I'll just talk about my observations with insurance companies and products, because I'm a nerd with this stuff. So there's your difference in guaranteed values. Now you've got your annual internal rate of return and your average internal rate of return. Annual represents what you've earned each year. I earned 30% in the market last year. That'd be my annual IRR. Average is what did you earn over the past 30 years? Good to be aware of both. And there's the difference. So your guaranteed rate dropped from 3 to 4%. And what's the difference you notice in the net? Look at that. Just look at the year 20 mark. A direct impact. Here's the biggest trade-off more than anything else. The PUA fee, that we can't help, but really the cash value difference. The old product has stronger guarantees. Right off the bat, $5,000 more, 10 years, $50,000 more. If I look at 30 years, $225,000 more in the old product compared to the new product based on the guarantees. What that means is if you have greater value, cash value, and death benefit based on the guarantees with a life insurance product, is that the majority of the risk is on them. If I see a lesser guaranteed cash value death benefit, what they've done more or less, and this is the case with all insurance carriers because they've had to do this, the risk is gradually being shifted from the insurance company to the consumer, a percentage of that risk. That's why I see lesser values based on what I've paid in and with that lesser guaranteed rate. Now, that's the trade-off. So if I'm a potential policyholder and I'm watching this before 2022 and trying to decide what option I want to go with, that's the drawback. My question would be, what's the advantage? Regardless of who you're working with, if it's us or anyone in the business. Old versus new based on the present dividend values. So what the insurance company is doing, all companies are really doing this, guarantees are less. That's the trade-off. So do I want a whole life product with strong guarantees? But then as I look at the dividends, the company is looking at it and saying, hey, while the guaranteed values are less, it's night and day, we are offering you greater potential here in earnings. As I look at this, what do you notice? Old product, 4% guarantee means based on the 5.65 dividend rate, you're at a 1.65% surplus. This annual dividend column only reflects the surplus. Anytime you see a dividend column on a life insurance illustration, that reflects the surplus only. So if I go back to the illustration, let's look at the old one first. This dividend column does not reflect a dividend rate of 5.65%. I wish that it did, just for transparency's sake. However, the dividend column does not include the guaranteed rate, everything but the guarantee. So if I have a guarantee of 4 and a surplus of 1.65%, that's what this is. Compared to the new one, a guarantee of 3 and a surplus of 2.65%. What that means is the dividend value in those columns will look stronger with the new products because it's a greater surplus portion based on the dividend rate today. If things go down, I'm going to see that change. If things go up, I'm going to see that change with both of them. But I'm going to look at the net values. So here we go. New product. When did you break even? I'm sorry, old product break even, 3 and 4. And I've seen Guardian been doing this. They're one of the major mutuals. They've always delivered, but we've really seen them just on point of late, which is always fun when companies are delivering like that. When I say on point, the actual performance compared to the illustrated performance and the net IRRs. So you have a 5.65% IRR. And there you go. Annualized IRR tops out a little over 4.1, and the average, factoring in all years, gets up to about 3.75%. Not even quite, not quite there, but solid. And where I always state, you can expect a well-designed policy with one of the major mutuals to deliver between 3 to 5%. That's still what I would expect with the old or new as we look at everything going on right now and where the companies have their assets positioned. New one, break even is year 5. I've paid in 500. I have 500. But look at the dividend difference there. So higher surplus means a higher dividend there. Higher surplus meaning a 2.65% surplus assumption, not 1.65. And year 5, you're at the 2.4% IRR. The old one, you're at 2.81%. But a higher dividend on the new one. The reason why the IRR is less on the new one is, again, going back to that PUA fee of 5%. That's what really hinders the product. But with a short pay, look at this jump. They both jump, the old one and the new one, but the new one really jumps because we're not pumping money in and we're not taking a hit with that 10% fee. So I'm sorry, over here, it's a 10% fee now. So you jump up to about 4.34%, and the annual IRR looks strong here. Again, by increasing their PUA fee, they're able to focus more on the long term with their non-guaranteed values, which is just like or just what Penn illustrates. Mass Mutual illustrates something more comparable to that. It's interesting when you look at how PUA fees impact long-term performance on illustrations, not actual performance from everything I've seen on illustrations though. But let's continue. And illustrations could be an indicator of something close to actuality. You can tell I'm a nerd at this stuff. 20 years in, CV difference, same dividend rate. If all things are equal, there's a difference there. Even if the dividend comes down a little bit, I can still expect that to the new one to produce stronger values. If it comes down a little bit, I ran some studies and that'll be in future videos as far as how low I have to go for it not to make sense. But there we go. Solid IRR over time. Now you're close to about 4.25 over the long haul. Whereas with the old one, topped out at about 3.7%. That's a difference, right? You've got north of 50 basis points, but it's non-guaranteed. So it depends on one's comfort level. You're with the one of the major mutuals, so it will deliver, but that's the kind of stuff I like to look at. And if you're watching this in 2022, this is this will be a solid option. This is just if you like the stronger guarantees, that's really where your decision factor can be weighed out. Let's look at the indexed feature briefly here. And we've got other content on this. You'll see a similar case to the dividend option where this projects strong long-term performance, almost at 5.2%. And that's an indexed net assumption of a little over 6% after their 2% fee and all that good stuff. All right, so that was the L95 5-pay. So a lot of good stuff here that we're going through. Next, we're going to transition into the L99, and then we're going to wrap up in respect to the numbers, looking at the different loan assumptions, and then we'll just kind of wrap it up with a couple notes here that I observed in reviewing these. I want to have both of these products. I already have the old one, a lot of it, but I'm definitely going to move forward with the new one as the years pass too. It's not bad. I mean, with Mass and Guardian, granted, I like the high guarantee, but still, it's not as if they killed the product altogether. They're still doing what they should be doing, in my opinion. So let's first just look at this guy, just the new one. I'm not going to compare the old versus the new in this example. Otherwise, this recording will be 3 hours long, which I could definitely talk about this for 3 hours, but I'm going to stop and get to the point. So what do we notice here? What I ran here, max funding for 7 years, up to the 100K Mech limit. Mech limit's actually a little bit overinflated with this example. With Guardian, we do have to do that if we're funding beyond 6 years in most cases. But still, what do we notice? Upfront cash value, about 83%. There we go. That's the big drawback. Break-even point. What do we see here? These are the guaranteed values here at 3%. An easy way to find it, unless you have a calculator or you can eyeball that quickly, is look at this guy. When the average IRR is no longer in the red, that's an indication of your break-even point. You've paid in 775, you've got 777, year 10. This is an L99. An L95 will break even earlier, as the L95 only overcharges us for the base premium in the first year. So we will see earlier break-even point. This guy, not quite as much. It's geared for long-term performance. Guarantees. Got to put that in the red. What do we notice here in the guarantees? Tops out on the IRR at what? 2.11% annualized, about 1.6% on the average. Safe, liquid, tax-free, still better than a bank account, but we see the drop there. And that's why I like those short pays too, if someone's working with a lump sum and focused on the IRRs. Everyone's different. That's why we're showing this example here. Dividend values. Here we go. 7 years, break even. Policy year 6. That's when you're in the black on the average IRR. Looks good. Keep pumping money in. This is a 1090 split, by the way. So we've got that base premium of $9,000 and change. Everything's the same here. Why we see a little bit weaker break-even point, the 95 was 16% and change, is we've got a larger term rider here, which pulled things down a little bit more. Then we've got the indexed feature values. Looking good in the neighborhood. All right. So looks great here as we look at all these values. Let's look at one thing I mentioned we're going to look at as a treat, comparing a 1090 to a 2575. And with the 2575, I did not use a 1-year term rider, since a lot of times we don't see a 1-year term rider attached with anything greater than a 2080 or 2575. So I did not. I used just a level 7-year term rider, dropped it after 7 years, or 10-year renewable term, but we dropped it after 7. Guaranteed values. When you break even, year 15, high base premium. You'll notice this every single time. So if I compare the guarantees, let's just look at year 30. And this is the 2575. That means we have a $25,000 base premium compared to the 1090, year 30, 1828. 1586, huge difference there. And we'll have split studies like we always have in the past, laying them out side by side. But then based on the non-guarantees, looking at the dividend, break even is when? Year 8. When was it with the L99 with the 1090? Year 6. If we look at year 30, what do we have there? 3,058,000 on the 1090. On the 2575, $3,018,000. And what happened with this, as I kind of did my thing and looked at a number of splits, is the higher we kept going with the base premium, the weaker and weaker the upfront and long-term cash value became with the different product options. It's more dividend sensitive, which I like something with stronger guarantees personally, and I like something that's historically proven PUA dollars are more favorable, even with the higher load. Indexed features, which not everyone really cares about, is more hypothetical, 3.633 year 30 compared to this guy, 3.798. Go 50 years down, dividend, 7858. We're going a lot of back and forth here. Old one or new one, 7.825. $10.90, 7850, 2575, 7825. So still 50 years down the road, you're still stronger with the 1090. That'll always, I don't want to say always be the case, always has been in reality, not just projections, which is what these are. So again, we'll have more videos in the future that really go into detail on that. I just know a lot of people are interested in the different splits, and it's always fun to kind of look at them. But same thing we've noticed from an observation, minimum premium, which results in minimum fees, minimum commission, all that good stuff is still resulting in greater consumer value. And I expect that to always be the case. That's really how corporation or corporate policies like BOLIs are modeled as well, or how they're built. All right, so let's wrap up here with the last number piece we're going to look at. So for some information, loan rate adjustments. This is specific to Guardian. When we look at the current, or I should call it old, Guardian has a fixed loan rate of 6%. That rate drops to 4% at the later of 20 years or age 65, whichever comes last. So if I start a policy at 30 years old, it'll happen at age 65. If I start a policy at 50 years old, that rate will drop to 4% at the end of 20 years. But that's their current. They do offer a variable loan rate at the 10th year, which has a current floor and rate of 4.5%. When we start a Guardian policy with a fixed rate, it is direct recognition. And if we select the variable loan rate offer, it'll convert to non-direct recognition. That's with the old product. Here's the new one. Fixed rate at 5%. At the later of 20 years or age 65, that rate drops to 3.5%. That's attractive when I look at distributions. And these are rates assuming I don't pay the interest up front. Remember, Guardian's a company that they bill interest in advance, and if I'm paying it up front or on my anniversary date, the effective rate is actually less than what we see here. And you're gonna see that when we look at the spreadsheet as well. So what we've also got, variable offer at the 10th year of 4%. So as the guarantee has come down, they dropped all of their loan rates accordingly as well, which is nice that they do that. In my opinion, I mean, they're trying to look out for the consumer in that respect. And this is for the most part, they're consumers. For a heavy borrower or someone that's very, very interested in how policy loans work and the direct recognition treatment, that's where we see things flip. So Guardian's direct recognition practice has always been to match the dividend rate to the loan rate. So for example, looking at the current or old product, if I have a dividend rate of 5.65% and a fixed loan rate of 6%, when I borrow, what does Guardian do? They raise the dividend rate on borrowed funds to match the loan interest rate. So quick example, you've got cash value of $100,000. You elect to loan out half of it. You take out a $50,000 loan. The cost to borrow is what? 6%. And you've got how much remaining? $50,000. Here's how this will work. If you had money in your policy, just letting it sit and grow, you would earn the 5.65%. You took a loan out. So whatever's still in cash value, you earn that dividend of 5.65%. However, you still earn a dividend on the outstanding loan portion of cash value. What Guardian does is raise the dividend rate to 6% to match the cost to borrow. So because the dividend rate is less than the loan rate right now, that don't hurt. We see a bump in dividend performance. So if I borrow and then repay it, I would actually see my cash value higher than what it would have been as if I never touched it in the first place. So that's nice, but here's what's not as nice. You probably know where I'm going with this, is based on the new loan rate, the treatment that Guardian practices is exactly the same, but the rates are different. So I've got a 5% loan rate and a 5.65% dividend. On paper, that looks all right. Now I got a positive spread, even though it's not, because I look at the net internal rate of return. But now that I have a 5% cost to borrow, here's what happens. Loan rates at 5%, money remaining in cash value, receives the 5.65% dividend. The money loaned receives a dividend rate equal to the loan rate of 5%, which is less than the 5.65%. So now when I borrow and repay, I see it a little bit less than it otherwise would have been. Good to be aware of that kind of stuff. And that's the case up until the 10th year. If I elect that variable loan interest rate, then it becomes non-direct recognition and it doesn't make a difference, meaning I get the same dividend on everything. But it's interesting how that works. So let's look at some numbers here real quick. This is a deep dive, but we gotta dive deep if you want to. If not, we've got some simplified content as well. So here's the old option, which is still available. If you have a policyholder with a 6% loan rate, this is what it will look like. If you have an 8% loan rate, I've got one of those. The same thing occurs with the 8% match. But we've got the 6%. We've got the 4.5% with the variable loan rate, but we're not going to really focus on that in this example because that's non-direct recognition. So what do you notice here? Old product, breaking even, year 4. Taking out a $300,000 loan at age 50. When I take that loan out, what do I notice here? Well, anytime you take a loan from a life insurance policy, the death benefit is going to be collateralized dollar for dollar plus the loan interest. So in the example where I just let it sit and grow, cash value was $657, death benefit was $2,038,000. I take out that $300,000 loan. There's a loan interest of about 17 grand. There's your death benefit reduction. Cash value reduced by just about how much? 300K. When you take a loan, the cash value is the gauge that determines how much you can borrow, the equity call it. Now we pulled out $300,000, but here's what I want to touch on. Loan interest is 6%. What's 6% of 300K? It's $18,000. That number right there is about a 5.66% rate. So if we pay the loan interest prior to the anniversary date or on the anniversary date, we don't let it go past that, they actually give us a discounted rate. It's about 5.66%. So actually, we've got other content on that, and I've been talking for a while here, so I'm not going to do the math. If you've got a calculator, you'll see it well. So we've got that rate right there, 5.66% billed in advance. I pay it back. Oops. But here's really what I want to touch on before I go any further here. I'm paying it back, but look at the dividend here at age 50. This one's about $1,000 higher. The reason why is this example. You are receiving a 5.65% dividend rate on everything. The direct recognition example, a bit different. Money still in cash value, 5.65%. Money loaned out, dividend of 6%. 0.35% spread. So what that results in, a little bit higher dividend. When I pay it back, cash value is restored, and a little bit more, 841. Over here, it's 837. At the same time, though, here's what I would really like to do. There we go. So there's the total interest payments I made at that 6%. And what's my cash value difference? About a $4,000 difference. Keep that in mind. Let's look at the new one. Direct recognition at 5%. All right. So upfront cash value, not as strong. There's the hit, in my opinion. That's where people are going to feel it the most. Just because we've been used to the higher cash value with Guardian for so long. But that's right. It's not awful, really, when I look at it. Yeah, I'd like it higher, but I do get it. And they're really positioning and protecting themselves for the long haul. But as we look at this over time, age 50, look at that. What do you notice in the dividend column? Significantly less. Here's why. Money still in cash value, 5.65% dividend. Money loaned out, 5% dividend. It's reduced now. So when I pay it back, example on the left, cash value. Let's look at, hold on, there we go. 871. Example on the right, 788. That's a difference there. It's a difference and a half. You're getting close to 100 grand. Now, things accelerate a bit after that. Next year, actually, that's when it's fully paid back, 913 to 878. Not quite 100 grand. You see the dividends kind of come back to earth as well. Let's look at 860 just to simplify. 1,026,000, 1,048,000. So now what's your difference? About $22,000. So a $22,000 difference. What did I pay in interest? Let's look at that. I did it again. I don't know why I do that. $50,000 in interest. Last one. $59,000 in interest. Do I earn more than $9,000 when I look at the cash value here at age 60, for example? No, about $22,000 in change in the hole. So it's something good to be aware of. Granted, right now we've got cash value collateral loans, which make all the sense in the world. Can also elect the non-direct recognition option as time passes. And Guardian's got so many other advantages that, I mean, I use them for their flexibility and guarantees, but still awareness is key. It's where I'm not aware of this kind of stuff is where I am not happy as a consumer. So let's wrap up. A lot of good stuff here, right? Deep dive if you really like understanding things in and out. And I'm barely, I don't want to say barely scratching the surface, but a lot of stuff I haven't covered. But I could talk about this forever. So key observations: old product, stronger guaranteed values across the board. That's a fact. New product, significantly stronger non-guaranteed values. When we compare them side by side, the new one does have greater potential there. New product, less cash up front, and this is primarily due to that PUA rider load being raised from 5 to 10%. And really the argument here is that this will increase long-term performance. And really that's several other companies' arguments as well. With the higher upfront PUA rider charge, we see that quite a bit. Now, with everything, as we always do, the numbers you just saw, we did use an optimal blend, minimum premium, minimum expenses, minimum compensation. I did play around with the numbers, especially due to that higher PUA fee, to see if higher base premiums of any type of structure would result in greater long-term performance. As I was nerding out all weekend, just kind of looking at the numbers, but they wouldn't. And again, I knew they wouldn't heading into it, but still, I like to see it before just assuming all of the facts are the same as they've always been. So lastly, the new product that complies with the 7702 changes, that does offer greater potential, but really the guaranteed values are less. So as I touched on in the beginning, the risk with lower guarantees, a portion of it has been shifted to the consumer. Not to say a whole life insurance product is risky, because the last bullet point, guaranteed values will still outpace the expenses. So that's where I've got the old whole life insurance product. Guaranteed values, guaranteed rates always exceed the actual insurance company expenses. That's the advantage there. But with that said, when I compare it to the old one, they're saying, okay, we cannot sustain this 4% guarantee anymore. So as we kick it down, that is a trade-off for the consumer based on the guarantees. Insurance company if the insurance company performs, meaning they do what they think they're going to do, greater consumer value. If the insurance company does not perform, less consumer value, which you could argue the same thing today based on the current rates and values, but you just have the guarantee as a fallback. Anyway, I know this was an in-depth video. Hope you enjoyed it. Feel free to reach out anytime. If you did enjoy, please click the like button, subscribe, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.